All right, we might kick off. Hello, everyone, and thank you so much for joining us today. We appreciate you taking the time. You're joining us today for What No One Tells You, and we are here today with our special guest, Andrew Cull from Sound Property. So lots and lots to talk about today, so we'll get into that very quickly. But Andrew, can you kick off by telling us a little bit about how you came into this industry and why you started Sound Property?
Thanks, Christy, and thanks everyone for coming today, and thanks to Working for hosting us. It's a great place to work here. Might be a bit biased. So look, a little bit about myself. Been in the industry now for 20 years in the property investment space, and about 14 years ago started Sound Property Group, and we're a buyer's agency that specialises in helping people grow their wealth through investment property around the country. The reason I started it was 14 years ago, property investment was very, one size fits all. You'd go and buy an off the plan unit somewhere, a house and land package. But I saw a little bit of a niche where that wasn't always the best for each individual investor. And for us, it's definitely not one size fits all when it comes to investing in property. All our clients are very different. They have different financial positions, different cash flow requirements, different vehicles. They might be investing in their super fund. They might own their home already. They might be renting. And so there's a real mixed bag. And so for us, it's really important to tailor our service to what that individual client's goals are. And at the time, there was not many people providing that type of service, that tailored service 14 odd years ago. And so Sound Property was born. And today obviously working here at Work Inc. And looking forward to chatting to you today about lots of noise in the media.
Yes. And thank you. And as everyone knows, there is a lot of noise in the media at the moment, a lot of new proposed changes, which I'm sure a lot of us have lots and lots of questions about. And that's why we thought that it would be really timely to talk to you all today about some of the changes and present to you a masterclass with Andrew. So can you tell us, first of all, to kick off, what are some of the biggest changes that have occurred within the industry?
Perfect. Two quick things. It's obviously a small group, so if anyone has any questions that I missed, please feel free to put up your hand and yell out, and we can answer those if you have any questions about the changes as well and how that might impact. Secondly, just a bit of a disclaimer, I'm not an accountant or a financial planner. I have been in the industry for a long time and do have my head around a lot of the tax changes, but if you are after any personal advice, please reach out to your accountant or financial planner to get that advice. But on to the elephant in the room, or the elephant on the media at the moment, is all about the budget. May 12, Labor announced some budget changes that directly affect property investors and obviously businesses in general with the capital gains tax. But the main two changes which they're looking to make, and again, this is still not, it's all proposed at this stage, it's not legislated, it has to get through the Senate. And Labor don't have the power in the Senate, and there is a little bit of back and forth at the moment just about what policy will get through. But the main two changes that affect property investors are changes to negative gearing, which we'll unpack in a second and tell you what is negative gearing and what the impacts might be there, and changes to capital gains tax discounts. And this affects actually all businesses and all investments, not just property. It's not isolated to property, and that's probably why it's a little bit more contentious, the capital gains tax changes at the moment, and is causing quite a lot of uproar and backlash and things like that, which is being worked through at the moment to see how that might play out. But yeah, importantly, this is all still proposed. It's not legislated, so we'll have to see what gets in. But what they're proposing, if we just break it up into negative gearing and then the capital gains tax, we might start talking about negative gearing. If you have any questions just about how it works, and again, excuse me if you guys all understand how negative gearing works, but I thought I'd just break it down very simply for you so that you can understand how it might affect you as a property investor. So how it works is that if you own a investment property historically, let's just say it receives $10,000 a year in rent, and then you have $20,000 a year in expenses. So the lion's share of that $20,000 will be obviously interest repayments, but there might be also some what they call on-paper deductions like depreciation and those types of things as well, which is adding up to that $20,000 loss. So over the year, obviously 10,000 in, 20,000 out, you're running a $10,000 shortfall, essentially, which the investor has to carry throughout the year to cover that shortfall. What's been happening in the past is that you can apply, when it comes to do your tax, you can apply that $10,000 loss against your income. And so, for instance, say you're on $100,000 for simplicity's sake, and you've been paying tax on $100,000 throughout the year. At the end of the year, you get that $10,000 taken off. So you should have really only been paying tax on $90,000. So you get your tax back, whatever tax rate you back on that $10,000. So at $100,000, that might be, if you're on a 30% tax rate, that might be a $3,000 rebate back in your tax. And so that at the end of the day, the properties only cost you then $7,000, not the full $10,000. So that's how negative gearing works. And now a lot of misconception out there, this is for the ultra wealthy that have been utilizing this negative gearing benefits. And it's actually not true. It's nurses, it's school teachers, it's services, like it's everyday Australians who have been benefiting from this tax system and to get ahead in life. So it's definitely not the super wealthy that are the only ones that benefit from
I think
it.
sometimes there is an assumption that it is the super wealthy, but what we're talking here is the changes that happen to everyday people like us in this room.
Yes, correct. Yeah, so it is a misconception that it's they're trying to the intergenerational wealth and trying to even out. It's actually going to affect everyday Australians rather than the super wealthy, which is something really important to note. So what the changes are proposed is that for going forward, anyone that buys a new property will be still eligible to receive negative gearing and capital gains, which we'll talk about in a second. Anyone that is buying established property will no longer be able to negatively gear the property. But another misconception, people think they just lost that ability to negatively gear. But what actually happens is that those $10,000 losses, say you incur those for 10 years, adds up to $100,000. That actually comes off your capital gains tax calculation. So it minimises your capital gains tax at the end. So you don't kind of lose the ability to negatively gear, you kind of just defer it to the capital gains tax calculation at the end as well. So that's, again, another misconception that people think that they're losing those negative gearing benefits. So a new property is basically, off the plan or house and land packages or anything that hasn't been lived in. So a developer might build something and hold on to it he can hold on to it for 12 months. But as long as you're buying it off the first owner, it's still considered new property. So that's another important distinction there. It's not just brand new off the plan stuff. You can actually buy stuff which is completed. It just needs to have been not lived in for more than 12 months and you're buying it off the builder or the developer still as well. And then if you're building new property yourself, if you're doing like a knockdown rebuild, that won't count towards new supply because you're not actually adding any new supply. You're replacing old with new with old. It's only if you knock a house down, if you build a duplex or if you build a couple, like subdivide the land and you're actually creating supply, that would be considered new property as well. So that's another important one there. Mm-hmm. So still on new property, on established property, anyone that owned established property prior to May 12th, which is the budget night, can still what they call have grandfathered arrangements, which means that if you own investment property pre-May 12th, then you are still actually eligible, as long as you hold on to that investment, to receive negative gearing benefits. There's also a honeymoon period. If you go and buy an established property now, if it gets legislated, you'll have until July 2027 to receive negative gearing benefits. Before, at that stage, they'll stop basically next year. So there's a year honeymoon there if you are buying established property at the moment. So that's the main kind of changes. Any questions on that? I'll talk about the impacts that I think it's going to have in a second, but is there any questions on how negative gearing kind of works and what the changes are? Renaud?
You mentioned the scenario with 10 years and 10 grand loss against capital gains after 10 years. Mm-hmm. Is it true that also offsets against income positively?
Yeah, correct. So the question was, if you hold the property for 10 years and you've been getting $10,000 losses each year, can you apply it against any, if the property, because what may happen in that 10-year period is the property actually turns positive cash flow. And that's if the rents are rising and say interest rates come down and you get to a position where it flips and you might be receiving $20,000 income, $10,000 expenses, the property's then becoming positive, what they call positive cash flow. And then yes, so if whatever losses that you've got will get applied against that income, then correct, moving. Yep. Yeah, correct. And it all comes down to the capital growth of the property, which we'll talk about in a second. And I've done some modelling on this to show the benefits of getting the right property. Again, and I'll urge people not to go out and just buy a new property to get negative gearing benefits. I'll explain that why shortly. But yeah, after a 10-year period, property is still a very lucrative asset class, which we can chat about shortly as well.
Yep. Any other questions at this point?
Big question, you mentioned turning an old property into a new one.
Yes.
Is there actually like any stipulation around that? Because you sort of said, oh, if there's two, then it's new. That's only one more instead of one. Is there an actual thing, or are they just wrong?
No, you've got to create new supply. So if you knock a house down and build two dwellings, you've created new supply. So you're eligible. Yeah, so that's I don't think that has been cleared yet, whether you'll get negative gearing on them both. I believe you will, because you're creating new supply. Because if you knock the house down and build 4 townhouses, it's going to be pretty hard to get negative gearing on one of the townhouses, but not all of them, especially if they're all still on one title and you're holding and that type of thing. So I believe it'll be on both the assets. You'll be getting negatively geared because you've added supply essentially as well, rather than it being one, not on one and one on the other. But it's only if you knock down the original house, obviously, and build 2 new ones, you'll be able to get it. So it doesn't apply. Granny flats, for instance, don't apply for negative gearing benefits as well, because you've yeah.
Okay. Yes.
Sorry, what was the original capital gains tax?
Yeah, we'll get on to capital gains tax in a second. I'll just finish. I'll talk about what I think the effects of negative gearing will be, and then we can chat. We'll unpack capital gains tax and what I think that will be. Any other questions on negative gearing? I'll just talk about what I feel the impacts are going to be. So based on history, like we have done this before. Back in the 80s, we removed negative gearing for a period of 2 years before they reinstated it, because what actually happened, rents around the country skyrocketed. About 25% nationally, more here in Sydney. They went up about 30%, the rents, as landlords obviously try and recoup the benefits they're getting from the negative gearing in the rent that they're getting. And so we saw kind of rents get pushed up. And not just here in New Zealand, more recently, they removed negative gearing, and then 4 years later, the rents skyrocketed and they've reintroduced it now 4 years later as well. So whether it sticks around or not, time will tell. We need private investment in this country. We've got a critical supply, which I'll chat about shortly. But does anyone want to guess over the last 25 years what percentage of housing approvals the government have actually contributed to? Does anyone want to hazard a guess?
Any guesses?
Close, 2%. So around 2%. So that means that 98% of rental stock is provided by everyday Australians. And if you are, changing the goalposts for them and driving them out of the market, we're going to see, like, where are people? We've already got lowest vacancy rates on history at the moment, about 0.7 odd percent. And so it's just going to make that problem, exuberate that problem and make it worse if 98% of housing is supplied by everyday Australians, basically, as well, who are just trying to do that. So it's an interesting little fact. The other thing which it's doing is when you go to get a loan off a bank, they, in the past, or if you're buying new property, can use the negative gearing in your servicing calculations as well. So it means that people can borrow a little bit more because the bank's seeing that they're getting that refund back at the end of the year through the negative gearing. And so a lot of the lenders now are toggling that switch off. And so when you go to get a loan with them at the moment, before you might have been able to get $1 million loan. Now it's dropping down to $800,000 loan. And so what that's going to do is actually put more pressure on the affordable end of the market, again, which is what they're saying that they're trying to help is younger people by making houses more affordable. It's actually going to cause more competition in that space because of people's reduced borrowing capacity at the moment in that space, which is another impact that I think will play out.
Yeah, I think lots of changes occurring. And I definitely think that everything that you've just mentioned is a great reason to, if you're thinking of investing anything property related, great reason to come and see you.
Yes.
Yeah.
You've got to get the property right. That's the important thing as well.
Yeah, correct.
Just moving on to capital gains tax as well. And so basically, when you own an asset, and this is not just property, this is any asset or any business, if you hold that asset for longer than 12 months, then you get a 50% discount on the gain before it's applied to your marginal tax rate. And so this is what the 50% CGT discount refers to. So for simplicity, let's say you own a property and you make $100,000 in profit and you've held it for longer than 12 months. Instead of paying tax on that $100,000, you pay tax on half of that, which is $50,000. And that's applied to your marginal tax rate for the year. And so what they're proposing is obviously to remove that and replace it with what they're calling an index, like an inflation index model, which means that basically if you buy a property for $1 million and you hold it for 10 years and in average inflation's been 3% per annum, then they'll work out what that increase, that inflated cost base is, and then work out your capital gains tax on top of that is what the indexed inflation model means. And so again, they're going to preserve it for people buying new properties. So you'll still be entitled to either a 50% discount or you can choose the inflation model, whatever's going to work best for you. The inflation index model, it really depends on how long you own the property. If you hold the property for 10 to 20 years, you'll get to a point where the indexed inflation starts to kind of, work out to the same as a 50% deduction anyway. But if you're looking to flip a property within 2 years, it's probably not going to be as beneficial compared to a 50% discount model. Now they're implementing this, they're bringing it in, again, anyone that buys established properties now will not get a CGT discount. Anyone that owns property will have to get their properties valued in July next year, which is going to be a massive task. There's literally millions of properties around the country that are going to have to get valued in July next year because that'll draw a line in the sand. Any growth up until that stage will be like the 50% discount rule will apply. If you hold that property for another 10 years, it'll flip onto the indexed inflation model for CGT discounting as well. So it's going to be a logistical nightmare, I think, in 12 months' time to get all these properties valued. The valuers are going to be very busy. So probably if it's a space you want to get into, the valuation industry might be very, very busy in 12 months' time. But that's the kind of main change to capital gains tax. Does anyone else have any questions on that? And I'll talk a little bit about some of the potential impacts. So what are some of the potential impacts? One that I missed on the negative gearing, if you own an established property pre-May, which is getting the negative gearing benefits, you're going to be pretty hesitant to sell that property now because if you're going to go and buy another, you're going to sell it and buy another established property, you're not going to get negative gearing benefits. So what that's actually going to do is reduce stock on the market because investors are going to be holding on to that again, and that's going to keep a real floor under any price crashes that the media are kind of talking about at the moment because people are going to hold on to those assets now. With the capital gains tax changes, people will be holding on to them for longer to make the inflation model work, comparatively to the discount that they would have got before. Again, that's just going to reduce stock on the market, not kind of increase stock on the market.
Yep.
Yeah.
Okay, so I guess it comes down to new versus established.
Mm-hmm.
Do you, as Sound Property, have a philosophy about what is the preferred choice? And I know that everyone's circumstance is individual to them, but what is your philosophy on that?
Yes, and I've actually modelled it out. If anyone wants, Dan's got a couple of just printouts that we've got over there. If anyone wants, we've just done 2 scenarios. If you were to go and buy a new property, new properties are usually in off-the-plan units in high-density areas. They're investor-dominated. they don't have a very good long-term capital growth rate. And that's history shows that in all the areas there. Or they're house and land packages out on the edges of town where there's just lots more land being released. And again, they just don't have the kind of same capital growth as buying something in an established, tightly held, owner-occupied area where there's no more supply or no more density allowed. So we've modelled like $2 million properties, one getting in an off-the-plan high-rise area, which might be getting a 4 to 5% long-term capital growth rate, versus buying an established house that's been achieving 8 to 9% long-term capital growth rate. And it's quite surprising, even though you get the negative gearing benefits on the new property, because you're not getting the capital growth as much over time, at the end of the 10 years, it's over 2.5 times better buying the established property than buying the new property. However, you're obviously got to manage your cash flow, which is really important over that 10-year period because you're not getting the tax refund every year. You just need to be able to manage your cash flow. But if you're picking one over the other and you've got the ability to hold it, and there's actually a good cash flow calculator. If anyone wants to, on our website, soundproperty.com.au, there's a free cash flow calculator where you can go and play around with these numbers for yourself and see how it might look, how your cash flow might look, and try it on to see how the property might look and how it might perform for you over the period of time. So we do that.
I have used that calculator on your website and it is excellent. Definitely recommend to go on there and play around with some numbers.
Yeah, it's really good to try it on, especially at the moment with the changes. If you're thinking about investing but not sure how it's going to fit with your lifestyle, what your out-of-pockets are going to be, it's really, really important. But yeah, the crux of it is that, and I'll talk about our philosophy in a second. I'll talk about a little bit about the market in general. But yeah, buying established properties in key high owner-occupied area, there's no more supply, is key to the performance of that investment. And I urge people not just to rush out and buy new just to get tax benefits, because they're such a secondary consideration when you're buying an asset. It's got the fundamentals need to be there for that property, which is really important.
Mm-hmm. And how do you select a particular area for investment or a particular property?
Yep. So we've got like 15 key investment driver framework that we generally use. Now we're licensed in most of the states around the country, and we have transacted in all those markets. But it's really important to start kind of on a macro level and understand what's going on in places like Brisbane or Adelaide or Perth or Melbourne, where they are in their cycle, what the population's doing, what the supply and demand in that area is. Then drill down to different suburbs and look at things like days on market and vacancy rates and amenities and infrastructure and all those, like what we call micro level drivers. And then we bring the property in at the end and look for things like bed, bath, car, land size, features, aspect, proximity to schools, all that kind of thing. I think a lot of novice investors get it the other way around, and they'll start with a property in their local suburb or their street even that they drive past every day, and they'll try and justify it as a good. They see it's for sale and go, "Oh, that might be a good investment."
Yeah. So you take all of the guesswork and all of the emotion completely out of that.
Correct.
And you're looking purely at where the growth is for the client.
Yeah, correct. It's because it's about the numbers. You take the emotion out of it when it comes to investing. It's about the numbers and obviously going to an area that has a proven track record. And so looking for areas that have high owner occupier, low supply, low vacancy rates, short days on market. These are all the kind of key metrics that you need to look at when you're investing. If you do go and buy something new, it's even more important that you are very selective when you are buying something new. Don't buy it from the glossy brochure. Because I think a lot of those markets, the secondary market in those areas will become very sluggish because people might be lured in initially for negative gearing benefits, but to try and resell that in an investor-dominated area where there's no owner-occupiers, the investors aren't going to want to buy it if they're not getting negative gearing and the capital growth's really limited. So you could get really stuck in those types of areas if you're just chasing, negative gearing benefits.
Yep. So we have. Oh, sorry. Yes.
Mm-hmm.
Given all these factors, what's your view on classic middle green suburbs?
Yes.
Where they're
perfect.
older houses, redevelopment, is that not going to?
I think so.
Especially investors that are sitting now on properties in those areas, all the amenities, etc.
they're generally our target markets. Those they're the established market, which are high in owner occupiers. Because owner occupiers tend to, even though we're investors and we want tenants in there, owner occupiers are the ones that get emotional when they go to an auction and push prices up. They tend to weather out when interest rates start going up. They're not going to go and sell their home. They'll tighten other levers in their life to manage that higher cash flow. So they're far less volatile, those areas, than like an investor-dominated area, like a one-bedroom unit on the Gold Coast or something like that would be, my idea of a bad investment versus buying in those kind of... They do, yeah. So I think those areas are going to always do well in this country. And just some of the other impacts, like as I said before, we've got a supply issue in this country. It's not a tax issue, it's a supply issue. We're just not building enough houses. We've got close to 500,000 people coming into the country each year. We're about over 260,000 homes short of our 2030 target at the moment for creating new supply for people as well.
What's the underlying supply?
We've got a massive undersupply. Vacancy rates are the lowest they've ever been in history. Build costs are actually, since COVID, have gone up about 40%, like costs of materials and labour. So even that, if that's kind of keep our costs and inflation driving that up, that's actually going to, again, create this manufactured growth in the market where the replacement cost of a house is going to kind of keep going up. And again, that'll keep a floor under any major correction or crash that the media might be telling us is going to happen at the moment.
So you say that we have a supply issue. Do these proposed changes directly impact that and address the supply issue?
Well, they don't. I think the logic behind it was to incentivize investors to buy new property, but it's so hard to get property off. Like, I've got a couple of friends in the development game. It's so expensive and it's so tricky with government red tape, with zoning restrictions, with time in council. It's not easy just to turn the tap on that supply by pushing people into new supply. So I don't think it's going to create this massive supply that they were kind of hoping to do. I think it's going to, the next six months will probably be people just getting their head around, waiting till things gets legislated, getting their head around the changes, doing their cash flow calculations. And then people will realise, they'll remember that we have a shortage in this country, and then we'll see the competition start to kind of come back in. Fixed rates now are starting to drop, which tells us that interest rate cycle might be nearing the top of this current cycle, and we might see some rate cuts next year, which again, all that just adds that fuel back into the fire. So I think there's a real window over the next kind of 6 months if you are looking to buy. Again, ignore all the noise in the media, shut it off, look at the long-term potential for property and the long-term performance. Because I've no doubt over the next 3, 5, 10 years, prices are going to be materially more than they are today.
Okay, great to know. We had a couple of great questions here. Does anyone else have any other questions at this point that we can go through now? Okay,
Yes.
so yes.
You just said that I kind of feel like they could just say pretty flat at the moment, so maybe it could take 2 years to wait.
Yeah, look, I don't think it's all going to come down to, the question was, obviously prices are a bit flat at the moment. Could it take kind of up to 2 years to prices to take off again? I think it won't be like it's a nuanced thing around the country. Different markets are doing different things at different times. I think Sydney will be a little bit flatter and probably more affected than any other capital with these changes, because a lot of investors rely on negative gearing because the prices are so much more expensive in Sydney than anywhere else. Negative gearing does play a big impact in investors investing in Sydney. And so again, if they're out of the market and they're looking in other places which might be a bit more lower price points, a better cash flow, I think will be less affected. So I think Sydney will probably be the most affected market, and I don't think it's going to take, again, if interest rates start to come down again next year, it'll start to take off again. I don't think if we go back and have a look at the last major corrections, the 90s recession, GFC, COVID, like the longest one of those was about 18 months. And even in COVID, all the economists were saying we're going to have the biggest crash on record. and prices actually exploded during that time as well. So I think you've always got to come back to the fundamentals. Again, try and block out the noise in the media and look at, it's a supply and demand thing. You know, do we have enough supply for the amount of demand that we've got? And we just don't in this country at the moment.
So what I'm hearing is that property can still be a great investment or addition to a overall portfolio. Now, we have a short window to July 27. What should people be doing now to prepare for these proposals if they do go through?
Yeah, well, obviously, if they do get legislated, the CGT one, you'll have to get, if you own property at the moment, you'll have to obviously get that valued by July next year. But I'd be really doing your numbers in the next 12 months, having a chat to your broker, seeing what your borrowing capacity is. Because, you know, now's, again, it's counter-cyclical buying. You just got to have that confidence to know that the market, you know, will in 3 to 5 to 10 years be more expensive than it is at the moment. And it's always best to buy when others aren't buying in terms of when the market's in this kind of phase that it's going through at the moment, because there's far less competition around and you potentially be getting a better price at the moment.
Yep.
Sorry, if you don't get your property valued next July, like, do they just give you a valuation when you go to sell?
No, I think you'll need to get it. It's going to be, from hearing an interview with the treasurer, it'll be up to the individual to get their properties valued if you want to lock in your capital gain up until that point. I don't think. Well, if you didn't get one, yeah, you're going to roll onto that. It'll be a lot harder for you to receive that 50% deduction. I don't know if there'll be penalties or anything like that if you don't get one done. I'm not too sure. Again, once this all gets legislated, a few of those intricacies will be more formalised. But it'd be in your, yeah, as I said, it'd be in your interest to get it so that at least you can lock in the 50% deduction for. Correct. They may give you some conservative, that, like, they may go off council rates, which are always, that's always a conservative valuation, the figure on your council rates. Yeah. With what their values are. Yeah. So I think it'll have to be done through a licensed valuation for, you won't be able to just jump onto RP data and go get an estimate, or for realestate.com. I don't think that's going to be satisfactory. I think they'll need a.
So if you were planning to sell kind of in the shorter term, you want your value high as possible to get the 20% off, right? Yeah,
correct. Or you might as well wait until, that, because it's just going to flip onto the index model. So you're not going to lose the capital gain discount that you've had up until now. It's just going to turn onto that index model, which means that you might need to hold it a little bit longer to get the same type of gain that you've had to date, essentially. Yeah.
We have a question.
Well, you can. You could get. I'm not too sure. Again, if you might want to wait till if there is any growth over the next 12 months, and if you've got it valued now, you may lose that kind of capital growth, and they'll probably come out with parameters that they'll need it done within a certain time frame, I'd say. So again, if you rushed out and got it valued now, I don't know whether that would be accepted in July next year.
And Andrew, what are your top tips that you can share with us today?
Yeah, so I think we've covered a few off. If you are going to go and invest in property, again, make sure the asset selection is critical. Over the last 13 years, just as a bit of a benchmark for the performance of our company, we've been achieving clients 12.4% compound capital growth on their properties on average, which is about, that over the last 13 or 14 years, house prices in this country have gone up 5 to 6% around the country. So again, through our asset selection, we've been doubling that return for our clients on average at 12.4% per annum. And it comes down to, again, buying the established properties where there's no more supply coming on, something with a bit of land content. We don't do a lot of units unless we're specifically asked. We mainly look at houses or townhouses for clients. And if they don't have the budget for Sydney, we'll look in Brisbane or Melbourne or Adelaide, or potentially some of the major regional centres as well. So Geelong, Toowoomba, Central Coast, Newcastle is probably as regional as we go, because we're quite conservative. We don't really speculate on any really regional markets. Again, that can be very risky to go to a mining town, as we saw after the GFC, a lot of that. So sticking to a capital city or a major regional hub is really important. buying something a bit of land, really important. Buying something established where there's no more supply coming on. Buying something where the days on market are short, that means that property's selling quickly and it's not just sitting around. That means that there's upward pressure on prices as well. So I think they're my top 6 tips when it comes to buying a sound property.
Great, thank you. Susan?
I was going to ask, what are your feelings about, like in Mosman with all the high rise, coming to Mosman, how do you think that will affect that kind of market? Yeah,
so like a lot of that high rise will be on Military Road, I assume as well. That's obviously where the zoning will allow that kind of density as well. Look, those properties, if you're buying one of those properties, that'll obviously be less capital growth than buying on, in the suburb of Mosman itself in the low density type areas as well. So I think it'll only make, that more, the established areas more expensive. And the high-rise units, because we just did a study in Neutral Bay, for instance, units there have grown about 4 to 5% over the last 20. Because everyone thinks, I had a client the other day that wanted to spend $1 million, and they were looking in Neutral Bay, they could only really get a 1-bedroom unit, and we said, okay, well, let's look at the past 20 years growth on that, and it came out at around 4.5% versus taking that $1 million and investing it somewhere where they could get a house and get 8 or 9%. And it was over 10 years. It's literally millions of dollars in difference in growth as well. Yeah. So I think we need that.
Trying to push people into these, all these new bills that are going on, they're allowing them to build them up, and then, you get your tax deduction.
Yeah.
They get investors to buy into things like
Yeah, look, and we need that. As I said, some people some people will be lured into that type of thinking, oh, it's Mosman. Mosman always goes up in value, all that kind of thing. But as I said, you've got to look at the long-term growth for those areas or that property type. Mosman's a great suburb for capital growth, but that property type won't be. But we need people to be lured into that, not you or I, hopefully, but we do need the masses because we need to create supply. So I'm all up for people buying off the plan units.
investors, they can push them in there.
Yeah, not our investors though, but I'm all up for people buying those because we need to create supply, obviously, to keep a bit of a lid on our rents and things.
Cool. We still have some more time, so if there are any more questions, I think this is a great forum and great opportunity to ask Andrew here. I just wanted to point out that on your chairs we have the brochure from Sound Property, as well as a QR code link directly to contact Andrew if you would like further information. So take those with you and please use them if you feel that there's a benefit. Anything else that you wanted to cover before we go to more questions?
I think we covered, a lot of it. As I said, it's just really important with property to keep a long-term view. It's not about what's happening in this kind of month, 2, 3 months. It's about the long-term trajectory. And over the last 150 years in Australia, we've had blips along the way, but property's never been in an extended downturn, and that will continue. And so if you are thinking to invest, but a bit worried about the noise, again, adopt that long-term approach and move forward. The other interesting thing we haven't talked about is just super funds, buying property in your self-managed super fund is becoming, it's probably 50% of what we've done at Sound Property. We deal with a lot of people buying in their super funds. They've largely been untouched by the budget changes. And so I think we're going to see that as becoming a more and more popular vehicle for people to be investing through their super. Because when you reach retirement age, you can actually sell that asset capital gains tax free. So there's no capital gains tax. And there's so many tax benefits to it, and the ability to leverage inside your super. So like basically borrowing the bank's money to benefit your retirement position is really powerful. And so the returns that you get, I think, and again, I'm a bit biased in property, but it can be smashed a lot of other asset classes.
Just on that point, we haven't talked about residential.
Mhm.
What about commercial?
Yep.
People are looking for a yield. It's worrying about the yield of income.
Yep. Yep.
Is that not a better, generally speaking?
We mainly deal with residential here at Sound Property. The commercial space, it comes down to what the client's requirement is. A lot of our clients are kind of accumulating and growing their wealth. They don't actually need the extra cash flow. They need that capital growth, because that's where you really create your wealth. Is the property doubling in value every 7 to 10 years is where you create your value. You don't kind of get that in commercial, and there is a little bit more risk, tenancy risk. So if you don't have a tenant for 6 months, you've got to wear that as well. And it's a bit more of a rich man's sport commercial property these days. Like you really need above $2 million, I think, to buy a decent commercial asset rather than just a 27 square meter office studio somewhere, which is just not a great investment long term. But yeah, commercial has its place for people just depending on their strategy and where they're at with their circumstances. Yep.
Joe.
What's your opinion for first-time buyers
Mhm.
in terms of reinvesting
Mhm.
versus buying a property for themselves?
Good
now?
question. So the question was the benefits of rent vesting versus buying your own home to live in. In somewhere like Sydney, we do with a lot of rent vestors as well. Obviously, Sydney, the prices are quite expensive. Young people want to live in Bondi and Manly and all the cool areas, at Paddington and wherever. Or at home, yeah, if they can milk that out for a bit longer. Because it's expensive to buy in Sydney and get your foot in the door. And so a lot of people forgo home ownership and rent where they want to live and invest where it makes a little bit more financial sense for them or where they can afford. And we do with a lot of rent investors. And it's a shame because the negative gearing proposed changes, if they're going to buy an established property, it directly affects that cohort of people who are just trying to get their foot on the ladder and, would benefit from a bit of negative gearing just to help their cash flow so that at least they can make a start in life. And so they've really been kind of put to the back seat, unfortunately. So I'm a big believer in rent vesting. The numbers are actually better because normally like a first home, it's not your forever home. So it's really just an investment, really. And the question is that the best investment for 5 years or so? Or could you have stayed renting and invested somewhere else that potentially will grow your deposit at a better rate so that you'll be able to come back to Sydney at some stage and buy a house that you don't have to make sacrifices. You don't have to move to the suburb you don't want to be in. You don't have to be in a studio versus a 1 or 2 bedroom unit that you might have to make sacrifices for initially. The government initiative with the 5% deposit scheme, again, I think has been a bit of a ridiculous policy because what it's actually done, 2 things. It's obviously put a lot of pressure in that kind of low end price point as well. But it could, like if prices in Sydney come back 5%, it could leave those with what they call negative equity, because if they've only put in a 5% deposit, say the market comes down 6%, then they're actually in debt on that property as well. So it's a bit dangerous to have a 5% deposit scheme for first time owners as well. But the grants that they offer, like a lot of people go, but if I buy, I get like, I'm not too sure what the grants are at the moment. I get like, a concession on stamp duty or whatever. In my experience, they're always dwarf. Again, they're secondary to buying a good quality asset that's going to grow their deposit. Don't just buy because you're getting a grant or something like that. You need to buy because the property is going to be going up in value. That's the important part.
Always these concessions they get factored into the price.
Yeah. Well, it's just put. So they just put an extra 5%. So instead of basically they've got an extra 5% in their pocket that they can just push kind of prices up in that kind of lower end of things as well. Yeah, look, I'm not too sure. We don't deal because we just specialise in the investment space. We don't deal with a lot of owner occupiers or first time investors. I'm not too sure, but it has been increased in Sydney. You might be correct around that 1.5 mark. Yeah.
And another question: what about the area of capital cities? You mentioned every market zone sort of.
Yep.
Environment.
Yeah, I'll do a quick sweep around the country if you like. So the question was, where are the good markets in the country at the moment to be buying? Obviously, we're here in Sydney today, which I've just mentioned might be the most affected with the proposed changes just because it's so expensive and people need negative gearing to hold assets here. So the secondary capitals, Perth, Adelaide and Brisbane have all been firing. Perth's gone up 20-25% the last 12 months alone. So even if the market comes back 10%, it still takes it back to the start of this year. It's hardly a big kind of drop. I'm a little bit hesitant with Perth. I think it's a bit artificial over there at the moment. There's been a lot of interstate investors propping up prices. There's a bit of mortgage stress from the locals not being able to kind of afford where prices are at the moment over there as well. It'll still probably do the best this year, I think, out of the capitals. But I just wonder, you'd be buying at the top of the cycle over there at the moment, and it is quite tied to the resource industry, like we saw after the GFC. Perth, from 2008 to 2019, Perth did 0 growth over a 10-year period. So again, if you'd bought at the top of that and then were expecting to see some growth, you would have had to wait basically 12 till now to see any kind of growth. Brisbane's been a market that we've been doing a lot in. I think it's still got a lot of legs. Obviously, the Olympics coming up in 2032 up there, it's going to transform it into more of a world city. There's a real buzz up there. I don't know if anyone's been up to Brisbane recently, but there's a real buzz on the ground up there at the moment. And so we still see some life in that market. Adelaide's been, again, a very surprising market and super hot and competitive down there when we've been transacting for clients down there. Things are constantly going above asking and expectation prices. Again, I just wonder, it has had a great run. I just wonder how much is left in the tank down there. I think Melbourne's one of the most opportune markets at the moment. Again, if you can tune out the media and what's kind of going on down there as well. Melbourne came out of COVID probably the worst out of any economy. Obviously, the government's got a few challenges down there and things like that at the moment. But it's the first time in my 20 years in property where I've seen rental yields now getting up over 4%. Rents are rising, vacancy rates are dropping, which is the first sign that a market is undersupplied. And it will only be a matter of time before that market starts to turn around. And we're positioning a lot of clients who want to get in like at the bottom of the cycle down to Melbourne at the moment, because you can get some really good buys down there. Yeah, so that's all the mainlands. We don't do a lot in Tasmania because, again, it can just be a bit cyclical down there. You can have peaks and like long troughs and things like that. And then, yeah, Geelong and Toowoomba up in Queensland and the Central Coast are other areas that we've been interested in. For someone that's on a bit more of a budget, might be looking in those markets.
Darwin.
We don't do a lot in Darwin either. Again, I think that market can be very up and down. As history's shown, it can be very volatile. Again, you can get very caught there where you buy in at the top and the market kind of crashes as well. So yeah, we just prefer to stick to, the major where there's good infrastructure, there's like diversity in its economy. That's the important thing, to kind of take a lot of the risk out of the investment as well.
Thank you.
Excellent.
So we've heard about the proposed changes, the impacts, some great tips and some good advice on great growth areas. And I think property, from what you've said, can still be a great part of your asset portfolio if done right. So thank you so much, Andrew, for joining us today and for sharing all of this with us. We really appreciate it.
Thanks, Christy. And thank you all for your time. Yeah, and like Christy said, if anyone wants to kind of catch up and chat about your specific situation or your kids' specific situation, we're just up the hall. Please feel free to reach out. I'd love to get to know a little bit more about your specific situations and see if we can help you formulate a bit of a plan.
Thank you.
Thank you.